Good morning, everyone. It's Wednesday, August 5th, and welcome to 7 Investing Live. This is our live stream event we host every Monday, Wednesday, and Friday at 10 o'clock Eastern Time to put a spotlight on several of the market's most innovative companies. And finding innovative companies is exactly what we do here at 7 Investing. My name is Simon Erickson, and I'm founder and CEO of 7 Investing. I'm joined by our executive producer, Heather Horton. Heather, it's a good week because we're at the beginning of the month, and we just published on Saturday our new August recommendation. It's an innovative company. It's a small cap company, not one of these huge mega caps you keep hearing out there, but it's also reporting earnings this week. And so we're going to be following along with what's going to be an interesting earnings report for that one. If you want to see the recommendation of this company, an innovator in this field that's been red hot lately, you can go to 7investing.com/subscribe. Get your first 7 days entirely free. We offer a completely risk-free trial for a week. You get to beta test 7 Investing, see our new reports, see our best buys from the last month, and all of our premium content with zero upfront costs. So 7investing.com/subscribe if you want to see our latest recommendation. Speaking of earnings, though, that's not the only company that's reporting this week. We've got a lot of earnings results going on right now, especially with technology. And the company we're going to focus on today is called Upstart Holdings. UPST for the ticker for this one. If you're unfamiliar with the company, they're using AI to facilitate consumer lending. This is a field that's more than $1 trillion in addressable market size. Upstart is using AI models to get an edge over its competitors. And we just got the results for Upstart's second quarter 2026 yesterday. So the title of this show is going to be Upstart, Q2 results, growth, profitable, and finally speaking Wall Street's language. That's important. And the first thing I want to show here is Paul Gu is the new CEO. He's one of the co-founders of the company. He's been around for more than a decade, been the chief technology officer, always been kind of the guy that's been building the AI models and methodically iterating them through the entire existence of this business. But he's taken on the helm here recently. He's taken on the helm as the CEO of the company. Look what he does. He comes out here directly on X, and he started posting a recap of all of the results directly for all of us to see. It's really, really neat that he's 100 days on the job and he comes out and he says, hey, everyone, I'm really excited to be here, but here's kind of the 3 things that stand out for me in the quarter. And this is kind of the theme of what I want to talk about with Upstart. It's important to understand this is a very, very complex business. There's a lot of things going on behind the scenes. He's using AI to disrupt a market that's $1 trillion and is very, very complex with thousands of inputs that he's using in his models. But Paul is still out there and in 2.5 minutes, distilling all of this down into a language that investors want to speak and kind of highlighting the most important things that we want to see from the business. I love that he's doing this. This is something that he's chosen to do right out there up front. He talked about when they did a share buyback just a couple of weeks ago. Now he's hitting a recap of their second quarter results. Great job, Paul. Great job at the helm. Only 100 days in. I really love to see that. Let's talk about 3 things here today. I think that Upstart's doing quite well. Again, this is a unique business model where you're actually using AI to facilitate originations. A lot of what Upstart is doing is simply just being the passing through those originations. They're actually going out there originating them. They're using AI to find somebody that looks like they're a legitimate borrower, matching them with the lender that would want to make that loan, and then passing it to the lender themselves, passing it to the bank to take that onto their own balance sheet. Simply a simple, toll booth model, an originator of the loans, you take a fee for doing that, and then it's up to the bank to facilitate the loan. But more and more, Upstart has been using its own algorithms to find those good borrowers and selectively put some of these loans on its own balance sheet, where it's selectively funding the loans and then servicing them throughout the whole life of it. And this gets complex very, very quickly. Some of the first things that Upstart would point out is the edge that it has over traditional credit models. And we've got kind of a neat chart here that Paul put together of saying, how is our model doing better than traditional models that are out there? It's a neat little chart, kind of a bar chart that shows what they're calling the credit model inaccuracy gap, right? So a 0% gap, which would be lower is better. 0% is perfect. That means the model perfectly predicts everything exactly how it works out. You get the exact right borrower that is absolutely going to repay this loan into exactly the right product, the right loan for them, and then everything just goes perfectly well. You can see these are not ever very perfect models. In fact, the traditional model, as defined by Upstart, using more than 1,000 of the proprietary inputs, the traditional credit model inaccuracy that's used by banks and regional banks when they go out there and they find a lender, they find a borrower, and then they make the loan to them, and then everything kind of follows as they expect, is about 95% inaccuracy. I'll say that again, 95% of the model is still inaccurate, and these are best-in-class models in the industry. And even Upstart, who thinks that theirs is even better than the traditional models used out there for credit modeling, is still at 87% inaccuracy. That doesn't mean they're making bad loans, by the way. This is still very good. They're still finding the right borrowers who, for the most part, are repaying those loans very well. But keep in mind, this is not the jumbo loans made to people that have a FICO credit score of 800 or more. These are going after subprime borrowers where a lot more things can happen. You've got unsecured loans where you don't have collateral like a house or a car to fall back on. Sometimes the APR and the interest rates on these are 20% plus. This is the unserved or underserved part of the market that is ripe for disruption, which is why Upstart exists. So to see the model getting better and better, knowing that they've got a 10-year head start on the competitors, is really disruptive and really great to see. I love that Paul is focusing on that first and foremost. But originally, when the company came out, and keeping in mind it's been public for quite a while now, I think Upstart did a little bit too much inside baseball and in the weeds and getting into explaining these things like these credit model inaccuracies and why our model is better and how the inputs of the AI model work. And I don't think that for the most part, as a publicly traded company, I don't think Wall Street really cared about a lot of that stuff in the back. It's good to have that. It's good to show how you've got an edge versus competitors, but you've only got so much time to talk about your quarterly results. They needed to focus more on speaking Wall Street's language. And I think that Upstart recognizes that, and Paul Gu is doing a good job with that. And so now we've gotten a little bit different on how Upstart is reporting. They phased some of their previous things out when they were first publicly traded, and they're focusing on some new metrics right now. Let's take a look at a couple of those first and foremost. Let's look at the number of originations driven by their core personal loans. This is just the number of total originations that they have year over year. It was $4.2 billion, up 50% on the top line. This is how many originations in total Upstart originated during the second quarter. And it's 558,000 loans. That's a lot. That's a lot of loans for, regional lenders. This is a lot more than a regional lender. If you're the Bank of Texas, Bank of Hawaii, Bank of Kentucky, whatever, it's really hard to go out there and find new clients that are really credit worthy. So what do? You partner with Upstart, you pay them a little bit of fee to find those loans, and then you transfer it over. That happened 558,000 times during the quarter, up 50%. Really, really good top line growth on that. And I also want to look at another chart here that shows the unsecured originations, which is sequential growth that's driven by core reacceleration. And this is the borrowers, right? This is like we were talking about before. Anybody can loan to those super prime borrowers, right? That green graph, if you got a credit score of 720 or above, me or Heather could loan you money. We know you're good for it. You're a really, really good, dependable borrower. You're going to repay your loan. This is where the traditional banks are fishing, is in that kind of lighter green at the top. But the edge that Upstart has is in these subprime borrowers or people that are not even subprime, but defined as a FICO score is less than 720. That's where their bread and butter is. And you can see those unsecured originations in kind of this part of the market. It continues to grow, overall year-over-year growth of 38%. This is the core of the business. This is what Upstart has been working mostly on for the last 10 years plus. They're continuing to do this really, really good, up 38% year-over-year, 20% quarter-over-quarter. There's more than enough loans in their core segment of unsecured consumer loans to go around for several more years. They're still tapping into this massive $1 trillion market. But look what else that Upstart is doing really good on the top line. They're going after secured loans now too, which are auto and home loans. And they're continuing to automate and to scale this as well. If we look at the next chart, which shows this was, by the way, the unsecured originations. Let's look now at the secured originations. And again, a secured loans mean that you have some kind of collateral to back up the loan if you don't pay it back, right? If you take out a home loan, they don't pay back your mortgage, they take the house. If you take an auto policy out and you don't pay back your auto loan, they take your car. There's some kind of collateral. Now, for you as the borrower, you get a better rate because there's collateral attached. There's also less risk for the lender. And for a while, Upstart didn't play in this market because it was already pretty well served, right? You had big banks who were willing to write auto policies. You'd have home equity lines of credit, things like this. But look at how Upstart has taken the knowledge that it's learned from unsecured loans, the AI models that it's built out on the underserved part of this population, and now they've transferred the automation of this to compete where the larger pool is, to compete against the larger companies in their own backyard. The number of auto loans year over year has quadrupled from 5,000 originations in the second quarter of 2025 to 20,000 in the second quarter of 2026. The number of home loans, which are mostly home equity lines of credit, goes from 1,000 in the second quarter of 2025 to 2,800, more than 2.5 times larger in the second quarter of 2026. Upstart, these are still very, very small numbers compared to the overall number of loans that they're doing in unsecured, but they're growing very, very quickly. And because they're fully automated, they're becoming more and more profitable now. So it's neat to see the mix between the originations, not just in Upstart's core businesses, but they've done a good job in previous quarters of learning and fine-tuning their algorithms, which meant a lot of kind of R&D work, a lot of costs, a lot of keeping those loans on their own balance sheet as they were experimental. Now they're unleashing it and they're getting 2 to 4x growth year over year, which I think is going to continue in the next couple of quarters. This is really good to see. And then the next thing that I want to talk about is how Upstart is now doing this very, very profitably. I want to look at the contribution profit that they have. I hope we have a chart for that somewhere. Yep. Oh, there's the number of loans. Let's see if we can pull up the all-time high contribution profit chart here, which just shows that Upstart has got a nice mix between, hey, where's our bread and butter that we're getting the core of our cash flows from, and our business is built around. That's the nest egg, the golden egg that keeps laying, or the golden goose keeps laying eggs for you. And then also the growth drivers of the business where we invested in the past, and then now that's taking off and growing very quickly. The company reported $193 million. Thank you, Heather. I'm putting you on the spot. You're doing fantastic keeping up with everything I'm asking for. $193 million of contribution profit in the second quarter, up 37% year over year. And look at that, contribution margin of 55%. Contribution margin takes into account all of the net revenues you get from a loan, whether you're keeping it on your own balance sheet or you're selling it off to someone else, minus all the acquisition costs of the customers. What do you have to pay for the traffic to get to the site to originate the loan? And if you're holding a loan, what is the cost of keeping that loan on your balance sheet? So 55% contribution margin. This is very, very profitable business, continuing to grow at scale. Fantastic to see for us as investors. Before we jump into kind of a discussion about what's going on, bigger picture, there's one more I want to look at, the total revenue. I want to show the fees that are being collected from the platform and the referral, from the servicing of the loans, and then also the net interest income from what Upstart is holding on their own balance sheets. $365 million in total net revenues in the second quarter of 2026, up 42% year over year, right? This is a nice mix. So you see the largest one is the darker green at the bottom. That's the fees that they're getting from mostly referring those loans and passing them on to other institutions. But you've also got a little bit of net interest income and fair value adjustments. That's for the loans that they're holding on their balance sheet. And one more, Heather, I've got one more, as I continue to rapid fire through all the graphics we've got for today's show, is looking at the mix of the loans too. This is a kind of a bar chart that shows the vast majority of Upstart loans have been funded by third parties. And it kind of shows the loans that are held at fair value versus the total loans outstanding. Kind of a neat chart. It's got kind of some white bars on it. You can see the return to GAAP profitability. This is really good for Wall Street to see this too, right? Just what's the bottom line? Show me the money. 17 million in net income. That's great. The one I want to show is Upstart is actually raising a lot of money. Perfect. There we go. The total loans outstanding continues to grow, right? When you look at the $18 billion that now got a total loans outstanding, they didn't have to raise any equity capital to fund those loans. They did take a little bit more on their own balance sheet, right? You can see the $1.01 billion that they had on their own balance sheet to 1.06 quarter over quarter. They did use a little bit of funding from themselves, but mostly they're just continuing to be a toll booth, serving their core bread and butter business without taking on too much risk out there. And something else that Paul pointed out has been a concern of the past of, hey, are you bloating your own balance sheet? Are you going to blow up if people don't pay their loans back? If we go through a tough time for the economy? He's very quick to point out that 5.9% of total loans outstanding is the balance of the loan balance that's held on their own balance sheet. That's a 2-year low. Certainly the lowest that you see in the year and a half or a year or so of this graph, but even farther back now, this is the lowest it's been in 8 quarters. 5.9% of total loans outstanding are now being held on the Upstart balance sheet that they're servicing themselves. And perhaps one more graphic. Let's look at the outlook that they reaffirmed, right? Upstart is no longer just managing the business and saying, hey, we got this, guys, we're doing the operations right. Let me tell you all about the AI model complexity, all these other things that are putting people to sleep and having the eyes glaze over for Wall Street. They're actually out there saying, hey, we're going to speak your language. Look, we're GAAP profitable. We reported positive net income. And we're going to give you not just a forecast for this fiscal year, but a 3-year target of where we see this business going through 2028. And so they come out there and they say, hey, this is how quickly we expect to grow our revenues at 35% a year, and then an adjusted EBITDA margin of 25%. This helps if you're a Wall Street analyst and needs to build a model with inputs. You've now got some long-term lines in the sand that you can hold this company to, and they're out there on conference calls and talking about how they're doing versus how you expected them to do. So we put this all together. Again, this is a very complex business and a very interesting industry because we've always used FICO score to determine if you are creditworthy or you're not creditworthy to borrow money, right? If you want to go out and get a home loan, there was literally a checklist. The bank would go out there and check, did you pass these tests? Can you get money from us, yes or no? Same thing with a car loan. Same thing with a consumer loan as well. It was just very, very structured all around your credit score. Upstart says we're not following the FICO score anymore. We're going to have our own proprietary model that's going to use more than 1,000 data points and fully automate this, where you don't even have an agent or a loan officer that's right there talking to you on the phone. It's just 99% of this in due time is going to be completely automated. You're going to get a decision in a couple of minutes. That's ridiculously complex. They've been doing that for 10 years. You're starting to finally see the growth at scale where the models work and they're actually profitable for the business. And Upstart now is being able to speak the language that investors want to hear, which is like, yes, you've got a lot of crazy stuff going on behind the scenes. It's working. We can trust you. You're reporting positive cash flows and positive net income. So I think this is a pretty good recorded quarter for Upstart here in Q2. The stock is responding very favorably to this, up about 7.5% this morning. We're now still only a $3 billion market cap. That is tiny, very, very small compared to the larger market cap of much larger banks out there. I think Upstart's got a lot of room to grow, and certainly this quarter showed that their top line is still growing gangbusters out there. Really exciting market, I think, Heather, for them to continue to grow into.
Yeah, I'm so excited to see how they're doing. I've been an Upstart investor a really long time, mostly because I just initially really liked that it was an alternative for people who were decent lends, but for some reason their FICO score wasn't quite where it needed to be.
Yeah, absolutely. And, speaking on behalf of an entrepreneur who does not have a traditional full-time job with everything just covered that checks all those boxes, I mean, you want to borrow money for things, in your life. People are going to want to do that. That's why the Upstarts exist out there. And as they get better and they fine-tune these models, they can start, offering better rates based on making sure they're getting the right borrowers. The people are going to pay back. You can get more attractive rates. You can get more types of loans. I mean, it's just, you can kind of see it expanding. And they've got so many banking partners that want to work with them out there too. It's kind of a win-win. One thing that's interesting now is Upstart is a bank. They've applied for a federal charter, federal national banking charter for Upstart Bank, that if they wanted to get lower deposits and actually use those to fund their own loans, they can do that too. It's going to be an interesting relationship between them and the regional lenders. They're obviously not going to go out there and screw over their customers, or these banks that want to make those loans too. But I think as long as you're transparent saying, hey, we are going to issue loans and use the collateral on our own balance sheet and the funding that we have on our own balance sheet now to do this, I think that's a kind of a win-win-win for all parties involved. Really neat company, really doing some disruptive things. Like you said, I'm glad to hear you've been an investor with them for a while.
So does that mean that that means they'll be actually holding these on their balance sheets, not just, let me pull this back up.
Yep.
Yeah. So go ahead.
Exactly like you said, most of the time Upstart will originate the loan, but then immediately they're going to say, okay, we're going to sell this off. This is a loan that we think you're going to pay back your loan. Our model says you're good. And then, here you are, Bank of Texas, you take the loan on. We found this person on our website for you, but we think this is one that you would want to service. They're probably pretty close to where you are. You can have a relationship with them, whatever you. But then a percentage of those, the 5.9% of the total loan balance out there, is on their own balance sheet. That means they are servicing the loan. They are collecting interest payments every quarter, every month, every year, whatever it might be, from these types of loans that they're making. And these are unsecured consumer loans out there for the most part. So you can actually borrow some of these. Upstart traditionally would do this just because they wanted to learn and fine tune the models, right? When they went out there and started making auto loans and home loans, they weren't just going to say, hey, customer Bank of Texas, we're trying something new out here and we don't really know if it's going to work or not, but we're going to go out there and get you a whole bunch of new customers. Banks would say, no, we're good. You figure it out first. And so Upstart would use a lot of their own funding that they have, their own capital they have, to fine tune those models, make them better and better. And now you kind of see the benefit of that, the scale of that, as they're able to say, hey, it worked. We've been doing this for a couple of years. We show that people are paying back. Here's the spreads. Here's the money that we're making from it. Are you comfortable offering auto and home loans through us that we would originate for you?
I just remember getting that number down was just such a huge focus early on. And I mean, it makes sense because the less of the actual loan you hold, the less risk you have. If you're the originator, you're getting fees and then you're out. So do we expect that number to start of what they hold on their balance sheets to increase pretty significantly now?
It's a good question that I'm not sure I know the answer to yet, because there's two things going on. One, they want to have fewer R&D loans because the stuff that they've been working on, the auto and the home policies, for example, um, they don't need to keep those as R&D learning loans anymore. The models are working. You can just pass those along. You do it just like you did with the unsecured loans. So in that regard, you would think, okay, they're just going to push those off. They're not going to need any of that balance on the balance sheet anymore. On the other side, you're now a chartered bank. You've got a national banking charter, so you can get much lower deposit rates. You can raise money to do those loans on your own if you wanted to do that. And so I think Upstart's going to, again, be very clear. I think they're going to tell the customers or their banking partners, look, we're going to make unsecured personal loans for you here. We're going to make auto and home loans for you here too. But maybe they're going to have some new products that they develop internally that they're going to speak very upfront, like, hey, we're going to do this on our own, and it's not going to interfere with the relationships we have with you. So maybe to be determined. 5.9% of all outstanding loans was a 2-year low in terms of what they're holding on their own balance sheet. Seems to be the direction I think that they want to head, at least right now.
Gotcha. That makes sense. And then I assume if they're actually holding the loans, they make more money off of them over time. I mean, that is why the risk is higher if they don't pay off. And so are those, do you know, significantly more profitable if they hold the loans versus if they sell them on?
Long term, it would be, because if everyone's paying back and you're doing exactly what you're supposed to, it's literally just like looking like a bank. You're collecting the interest payments and everybody pays it back and everything's fine. As opposed to the traditional kind of pass-through model they've had, just a service fee upfront. It's an origination fee, just like you would do with you originate a mortgage with somebody, they sell it off to Chase Bank later on, then Chase manages it. It's the balance between the two of those. We've seen a firm do this too. It's kind of how risky do you want this business to be? And then how are you valued by the market? Are you a software company? Are you just the originator of the loans that's using AI to do that? Okay, cool. You might have a really, really good multiple doing that versus are you a bank? Are you valued like a bank where you'd be a price to book value of the assets that you hold? I mean, Upstart's kind of in between the two of those. It's always struggled to describe itself to investors. And I think that for the most part, that's why Paul's wanting to say very, very, very strategically, he's saying, look, we got this. You don't need to get inside baseball. If you want to talk shop with me, I'll do this at the investor days. But like investors on the quarterly results, I want to show that originations are growing. Our new growth drivers are working and we're generating GAAP income now. I think he's keeping it simple for a good reason.
It's great to see. They seem to be going in a good direction. And yeah, it's turned out to be a pretty good stock.
Really neat one that was a market darling, came out really, really hot right after its IPO, gave a lot of that back when credit tightened back the year after that, and has really been recovering again. I think that the moral of the story is, stay the course on this. Always think long term. There's going to be a lot of volatility in lending. That's just the way the consumer cycle works. It's the way the financial markets work. Upstart has gotten to a place now that they can ride out the ups and the downs with a little bit more normalized earnings. Whether it's collecting interest payments from the borrowers or whether being so established with multiple products they can offer now. I think that this is a different Upstart than we saw right out of the gate, which is good for us as investors. Excited to see where this one goes. Again, UPST, if you want to follow along with Upstart, really good one. We've got a lot of coverage on 7investing.com if you want to follow along with what we're doing there. 7investing.com/UPST if you want to see our coverage. And again, 7investing.com/subscribe if you want to see our official recommendations, including the official recommendation here for August. So today was August 5th. We've got a lot of earnings. We've got a boatload of earnings even on tap for here today. We're going to be talking quite a bit in the next couple of days. And on that note, I think we'll have another show on Friday. In the meantime, have a great rest of your week. We'll see you again in a couple of days.